Hi, everybody. This is Alan Ellman, the Blue Collar Investor, welcoming you to this BCI podcast number 174, titled Rolling Up a Covered Call Trade in the Same Contract Month. We're going to be using a real-life example with Ford Motor Company, which trades on the New York Stock Exchange under the ticker symbol F. And this is a trade that was shared with me by a member of the BCI community. So let's start by defining what is rolling up a covered call trade in the same contract month. Well, this is where, after establishing our covered call position, buying the stock and then selling the short call, we then buy back that short call and sell a higher strike price with the same expiration date. So as the price of the stock increases, we can then roll up to a higher strike price. Now, this is done in the very same contract cycle, which is generally not a covered call writing exit strategy in our BCI methodology, because our concern is if the price is going up so quickly that it puts us in a position to roll up, there may be some profit taken that can hurt us. However, this was implemented, so we're going to break it down. And I'll just tell you right now that it was a very successful trade, but we're going to evaluate it and see if we could have done even better. Now, this trade was shared to me in 2/18, on 2/18/22. So it's actually a trade which was a 6-month trade written in August of 21 for that 2/18/22 expiration. So we're going to break down the mathematical components of the trade, and we're going to offer some analysis as how the trade results could have been elevated to even a higher degree. So here we go. This is the information that was shared with me. In August of 2021, Ford was purchased at $12 a share. At that time, a 2/18/22, so approximately 6 months out. It was never shared with me the specific date that the trade was entered. It's not important. So it was about a 6-month trade, and the out of the money 14 call was sold at 50 cents. So the initial time value return was slightly over 4%. Now, a few months later, on November 19th, 21, Ford had increased in value from 12 all the way up to 1939. Now, remember, the 14 covered call ceiling was in place. So what happened? The 14 call was closed at 570. Now, of that 570, since Ford was trading at 1939, the 14 call had an intrinsic value of 539. So of that 570, 539 was intrinsic value, 31 cents was time value. Now, at that same time, the 14 call was rolled up to the 17 strike. Now, since Ford was trading at 1939, that 17 strike was in the money compared to the 1939 value of Ford at that point in time. And the premium that was generated was $3.25. So you can see there was a net debit on the option side, since the cost to close was $5.70 and the premium generated was $3.25. But now the value of Ford, unrealized I should say, went from 12, which was the initial, from 14 rather, which was the initial cap, to now the new strike price of 17. So it went up $3 a share, the unrealized value of Ford, by rolling up in the same contract cycle. So let's have a look now at the entering of that initial trade using the BCI trade management calculator I'll mention briefly at the end. This is a must for any of you who are using covered call writing or selling cash secured puts. So you could see here that I'm going to use the date 8/16. We'll put it right in the middle of the month. And the 2/18/22 14 strike was sold at 50 cents. At the time, Ford was trading at $12 a share. Now, the spreadsheet will let us know that if taken through expiration, and for those of you who are also watching this podcast, circled in red, it's a 187-day trade. So the initial time value return, as I said before, was 4.17%, a little over 4%, and that would be annualized to 8.13% based on that 187-day trade. You can also see, for those watching, highlighted in green, that the upside potential, if Ford did go from 12 to 14, represented an additional 16.67% return for that 187-day trade. So there's close to a 21% annualized or return at that point in time, the 417 and the 6.67. And so that was a very, very nice return, but there's a couple of issues that I would like to point out to you. First, let's look at the rolling up calculation. And what we do is we enter into the spreadsheet a trade adjustment that on 11/19/22, we're going to roll up. Now, in the spreadsheet, we do have an exit strategy for rolling up, but since we typically don't roll up in the same contract cycle, it's called rolling out and up. Now, the numbers and calculations will be the same. So you could use it for rolling up in the same contract cycle. So first we select that exit strategy, and then we put down the date, adjustment date is 11/19. The cost to close, as I stated before, was $5.70, and the 17 strike was then sold at $3.25, $3.25. The unrealized profit on the stock was $17, the higher strike, and then the spreadsheet will do the calculations for us. So the net options position, because of that large cost to close of $5.70, was $1.95 a share, $195 a contract, which represented a loss of 16.25%. However, on the stock side, remember Ford was purchased at 12, and now the unrealized value is 17, the higher strike, which represented a profit of $5 per share. Keep in mind it's unrealized because we haven't sold the shares. $500 a contract, which represents an unrealized stock profit of 41.67%. Now, at that point in time, the final results, if the value of Ford was 17 at the expiration date, would represent a net profit of $305 per contract, or 25.42%. And again, remember that was a 187-day trade. So pretty good. I mean, you can't argue with success and making money. But there are certain things I think it's very important that I point out to you as how to improve this series of trade. Now, number one, and this goes for all trades, using shorter term expiration dates will result in greater annualized returns. So just because a trade is looking successful doesn't mean we can't look for ways to make it even better. And that's one way to do it. Also, using shorter term expirations will allow us to reevaluate our bullish assumptions on that underlying security on a more frequent basis, right? We may love the stock in August, and we may hate the stock in January. Okay, so it'll give us an opportunity using shorter term expirations. Now, this is another important thing that I want to point out to you. These trades, if taken through expiration, will bring us through two earnings reports, one on 10/27 and another one on 1/26. Now, it's true, the October report did result in an exponential share appreciation, which I showed you with this trade. But it could have gone the other way. And so, and the trader could have made even more money had that short call ceiling not been in place and he held on to the shares. So it looked good, but could have been even better. Now, in November, at that point in time, the January 26th report does represent another potential risk of a disappointing report. Do you want to undertake that risk? I say no. Let's summarize. In November 2021, this certainly represented a successful series of trades. There's no doubt about it. However, greater returns and lower risk could have been accomplished by following the BCI rules and guidelines. Two positives resulted from the trades. Money was made and lessons were learned. So if we could learn lessons and make money at the same time, wow, is that a great combination for us? Before I go, I want to mention to you our three best packages for our educational products and tools. First, our BCI package, which is an acronym for our best and most comprehensive investment package ever offered by the blue collar investor. It includes 6 online video courses, about 2 hours each, with downloadable workbooks, 6 calculated spreadsheets invented by the blue collar investor, found nowhere else, 5 of our best selling books in ebook format, and our annual 13-month premium membership, where we give you 4 reports of eligible option selling candidates, along with over 250 training videos, along with dozens of additional downloads and resources. That's included in the BCI package. Our second of our best discounted packages is the Trade Management Calculator package, TMC, and I showed you the TMC in action in this podcast. And it includes the spreadsheet, which has over 2,500 formulas in it, along with its 28-page user guide and the PDF version of my 8th book, Exit Strategies for Covered Call Writing and Selling Cash Secured Puts, 27 chapters of exit strategy information. And the third of our best discounted packages is our CEO package, which is an acronym for Combining Exchange Traded Funds and Stock Options. It's a practical, user-friendly, time-efficient way of using covered call writing, where we reduce the number of underlying securities to consider from over 8,500 down to 11, and the number of covered call writing exit strategies from 14 to 4. And it also includes 2 new spreadsheets created by the blue collar investor. You can get more information on these best discounted packages by going to our website. You could see the URL at the bottom. For those of you not watching, it's thebluecollarinvestor.com, and clicking on the link at the top that says Best Discounted Packages. You can also go to our store to purchase products individually, thebluecollarinvestor.com/store. Ladies and gentlemen, I want to thank you very, very much for taking the time to watch and or listen to this BCI podcast number 174, rolling up in the same contract month. Folks, I hope you enjoyed this presentation, but most importantly, I hope it puts cash in your pockets. As always, this is Alan Ellman, the Blue Collar Investor. Take care, everybody.